Hey, how's it going? On this channel, you will learn the steps it takes to make a full-time income trading in the stock market. So if you're new here, consider subscribing. And today, we're talking about debit spread. So as just an example, let's look at SPY, which is the S&P 500 ETF, and we will use this as our stock we're going to first buy a call debit spread on. So we think that this stock is, or this ETF is going to keep going up, and so we're going to buy a call debit spread. Now the easiest way to think of a call debit spread is the exact same thing as buying a call. If the stock keeps going up here, then we are going to make money, and if it goes down, we're going to lose money. But unlike buying a call has unlimited potential for profit. It does have that risk of losing all of the value of that call if the stock goes down against you. But with buying a debit spread, you do cut that unlimited potential to the upside, but on the positive, you do kind of cut that risk down as well. So spreads are always just the more safe side of buying or selling just a naked option by themselves. And so those do have their positives and negatives, and it's just another way to trade. You don't have to use spreads. You can just go on and buy a call here, but you do want to keep in mind that you are putting more risk on the table. So if you have a small account or you just want to keep your risk small, a spread is usually the way to go. Now, a call debit spread means you usually buy the more expensive call and then sell the cheap call as protection. So for instance here, we could buy the 298 call and then sell the 300 call as protection. Now that would give us about 150 or 200 at the most potential profit, because that spread would be 2 points wide. And so if we quickly want to go look at that, we can go to the Analyze tab, and we would be buying the 208. So we want to go right click, buy vertical, and then that'll put it down here. And we want to buy the 208 and then sell the 300 as protection. Now it looks like we would have to buy this for about $100, and then that would give us kind of about $100 as well as potential profit. So if we look here at the risk profile, down here our max risk on the trade would be how much we pay for it, is that $95, $96, and then up here our max potential profit would be $100. So this would be about a 1-to-1 ratio on that call debit spread. And keep in mind that our theta will be about even. And so this can be a really good setup to do. Now, sometimes it's better to do something that's a little more aggressive. If you're wanting to risk a small amount to kind of make a large amount, that's what you can do with these debit spreads. It's really the same thing as buying an out of the money call, but you do risk a little less money. Now, so what we can do there is we could instead go and buy the 300 call and then sell the, let's say, 302 as protection. So down here, we're going to buy the 300, switch this to 302, and we can see what that kind of looks like. And so that would be buying that for $62, and that would give us that potential for $137 return. And so you're kind of risking a lot less to make more. But the downside to that is it is less likely that you'll get there. Now you can see that you do start to gain money pretty quickly as the stock goes in your favor. So I would say with these kind of spreads, you do want to close them out pretty quickly and aggressively once the stock starts moving in your favor, because you do have that potential. When a spread gets to about above 80% or 70% max profit, it starts to taper off here with how much money you make for every point the stock moves up. So you can see based on the graph right here, really the beginning and all the way up to about $100 on this trade is really the sweet spot to where it starts to taper off. So if you were buying this debit spread here, we want to see the market move up to about 305, and then that's when we would want to close the trade for the profit. We wouldn't really want to hold on to it much longer, because you start risking more money for how much you have. Because if we're up about $100 on this trade, the most we can make after that is that $37. So we have a potential to make $37, but then we're risking the 100 we have already made on the trade, and then plus that $63 we had to pay for it. So it'd be risking $163 to make 37, and that risk to reward isn't really good. You want to be in this trade when the risk to reward is in your favor, and once you kind of get to that point, it really doesn't get to be in your favor. And so this looks like a pretty good trade. We can actually go and set this up as a trade. Now let me just see, we're 14 days out, so you can see that with the SPY here, the SPY has it to where they have expirations every 3 days. Now we can go set this up as an actual trade. So we are doing the 14-day out, and unlike normal stocks, the S&P 500 ETFs have expirations a lot quicker. That you can see it's basically every 2 to 3 days, and that's just a nature of how the SPY works. Because it's a lot more liquid, they allow you to have those extra expirations. Now, so what we were doing is we were going to buy the 300 and then vertical, and we want to change this to 302, I believe we had it, and we're getting filled at 64 price, and we always want to try and get the mid price. Now down here you can see that the natural and the mid are very close. The one good thing about trading the S&P 500 is it's very liquid, meaning there's a lot of people trading it, and so the price between the buyers and sellers is really tight. You can see here that there is the bid and the ask are 1 penny difference, and so you're never going to have a problem getting filled at a good price, and you're pretty much always going to get filled very quickly just because the prices are so close. So if we then click confirm and send on this, it'll say our max profit is 136 and our max loss is 64 for how much we're paying for it. So we can send that in, and you can see right away we basically instantly get filled, and that's because of the liquidity of the S&P 500 and how quickly it moves. Now right away, before I even go look at anything else, I'm going to create a closing order to buy that back at the profit we wanted, because it's good to put that in right away. You want to have it so you have a plan to buy your stock back for a profit or cut it for a loss when it gets to a point in your trade, so you don't have to worry about it or keep checking on it when the trade is going. So we want to then sell this trade. We were going for that $100 max profit, so it's going to be that 64 we had plus 100. So all we have to do is just put a 1 here and then change this to good till cancel. So that'll make it so that this order stays after the market closes. The good till cancel keeps it going. If we left that on day, the order would get canceled at the end of the day, but we want this to stay on until we actually close out of the trade. And so here, this will show us the opposite, and we will be trying to gain that 164 profit, and then our loss doesn't really matter. This is just our closing order for the max profit, and we will send that in, and then that'll just sit there. And we can go back to the chart and actually look and see that limit order up here sitting there and waiting for the stock to move up. Now where this limit order is, that doesn't necessarily mean your spread is going to close at 305. It'll probably close somewhere in that area, but because there's so many factors affecting the price of options and spreads, it'll fluctuate as the stock moves up there based on a lot of different things. But the idea is right now, if the stock was there, it would probably close around that price. But once it gets there, that means volatility will change. There'll be theta difference. There'll be a lot of different things changing the price of that option. Now on the flip side, you want to have a reason or something telling you to close this trade as well. Now sadly on Thinkorswim, unlike stocks, you can't have a profit and a stop loss for options at the same time. And so we have to kind of make our own, and I like to do that using a alert. Now let's just say we want to have it so if the stock breaks below the bar right here, we want to close out of the trade. So we're going to give it a little bit of room and then create an alert here, and then we want to know if the stock is at or below that point on the chart we just clicked, and it is going to send us a mobile text and also doing a sound on the platform if you're still logged in. But quite often these things will happen when maybe you're not on the computer, if you're not on the computer all day. And so we'll just create and send that in, and you can see it. So if the stock goes right below this line, it'll send you an alert, and you can just know that you should close your trade. The biggest reason to do this is having your plan right as you go into a trade is so that you know when to close profits and you have a reason to get out of the trade. Because once you're in a trade, it is very easy to get emotional or make a decision based on emotions. You really don't get smarter as the trade goes. You just get more emotional, and that can cause you to, either if the stock starts going against you, you want to start moving this down and giving yourself more room just in case, or as the stock goes up, you want to start moving this limit higher because you just want more and more profit. Now, that's a lot harder to do with spreads, and that's really a huge reason why I actually do like spreads, is because it's a lot easier to get greedy with calls, because as the stock goes up, profit potential on calls is unlimited, but in a lot of ways that is kind of a trap to get you to be more greedy and keep going for more and more profit, when you probably should just close the trade out and get the easy money. I always say it is way better to go for the easy money than go for all of it. Now let's quickly set up a debit spread to the short side. I will go over it a little quicker just because they're very similar in nature. Now let's just find another ETF real quick. We'll do the tech sector. The QQQ is the top 100 tech stocks ETF, and so this is another very liquid market, and we would just pretend that we think for some reason this is going to go down. I wouldn't suggest that in reality, just because that this looks like a pretty solid uptrend and pretty scary and pretty risky in a lot of ways. It's generally better to stay with the trend. Now, so let's go and quickly do a quick analyze tab of this, and we will add a simulated trade. Now you can see that unlike the SPY, even though the Qs is liquid, it doesn't have all those expiration or extra expiration dates, but the spread size is still essentially at the money, is 1 penny wide, which is still very good. Now we're going to want to actually go over to the put side though, because we are wanting to short this, and so we are going to be buying a put and then selling another one as protection. So we'll just try the at the money and see kind of what kind of money and value that gives us for our risk. Sometimes you can get a bad value for a trade, and that means you don't necessarily want to take the trade on. Now we are going to want to make this a little bit larger. You can see this is a 50-cent wide spread, and that is kind of small. Even if you're trading a small account, you probably want to make it a little bit bigger than this. So we're going to be selling the or buying the at the money, and then we'll want to we can make this a couple points wide. So we can actually kind of make this kind of a big one. This will give us about 150 profit, 140. And so as the stock goes down, this is actually kind of the flip of the last one we did. We have 137 max profit and 63 max loss, and this is just on the flip side. And so this the purple line again is kind of the current price of if the stock was there, and the more reddish line is at expiration. So at expiration, if it is below 188, you will hit max profit, and if it's below 190, essentially if it's above our price that we sell, and if it's below the price that we buy, that's where your max loss and max profit will be, and anywhere between that will be either a small loss or a large gain. Now we can set that up, and now one thing with spreads that you want to keep in mind is I suggest not holding them to expiration, because as you get close to expiration, it can be very detrimental or very volatile of what happens to the stock. So if we quickly go back to the Analyze tab, so if the stock is right here at our break-even price of 198, we won't be down or up any money. But if the stock moves $1, we will be at max loss. And then if the stock then moves, a dollar in the other direction, we will be at max profit. But that can be very volatile right at the end. And if your trade is already up, let's say 80%, and you already have collected $100 on the trade, it can, in just a snap of a finger, you could go all the way to max loss when you are at expiration, and that can be very scary, and it can make your trade go from a big winner to a big loser very quickly. So I would always suggest closing these out 3 days before expiration, just because you don't want to have to deal with the volatility of your trade. It's a lot better to have these kind of be a little more controlled. Now this is kind of the same setup down here. This is okay being day, because we're planning to get filled right now on this trade, and then we can click confirm and send, do a quick check, max profit 137 like we wanted, max loss 63 on a 2-point wide, and we can send that in. And it might not get filled right away because this market is not as liquid as the SPY. So if we don't get filled for a while, if you're waiting for a few minutes and doesn't get filled, or the market's moving very quickly and you want to get filled, and so there we did get filled. But if you aren't getting filled, you'll see right up here, it'll have a order in, and you can right click, and what will come up is you can cancel, replace order, and then you can change. It'll pop up down here again, and you can change and replace it. So quickly going in here, we want to then create that buy order again and just change this, add this a 1 again, because we want to get that extra $100. It's really easy when it's the exact flip of our other trade. We don't have to do any extra math, and we want to change this till good till cancel, and then just confirm and send, and that'll go in, and then we don't have to really think about that. And you can see we have that limit order down there, and we can say that maybe we want to have our stop loss of the trade being, maybe we want to give it a little bit more room. You can see this is like 50-cent difference, so we could give the stock up to here to where we wanted to close this. So we can set an alert at or above, and then it'll send us a text and an alert on the platform. So, and then we have that set up now. So that is pretty easy. We don't really have to do anything. We don't have to actually, you never really have to check on this trade. It'll either close itself out, or you'll get a message, which is really nice, because then you don't have to be, feeling like you have to get on the computer all the time or checking your phone to see what the stock's doing. It's really hands off, this kind of way of trading. And if you're trying to have a full-time job, this actually allows you to do that. In a lot of ways, you could either set this up in the morning, maybe before you go to work, and then it'll do this for you. And then maybe if you get a text on your phone, you quickly open the TOS platform on your phone, and it's pretty easy to go and do a closing order on there. You would just go to your monitor tab on your phone, and you could go to, let's say we wanted to close the QQQ one, and you can actually just right click, and then you would sell vertical, and you could just hit the mid price or even the natural if you just wanted to make sure you got out of it without having to worry about it getting filled. The natural price will always fill you no matter what. Hey, thanks for checking out this video. I hope you liked it. If you want to learn more and you like this kind of content, make sure to like and subscribe. And if you have any questions, don't hesitate to ask them in the comments below.